Right, welcome back. It's the part-time trader with the weekly market view. I've been a bit quiet this week, as you will have seen on X. I had quite a lot going on personally, but also the markets have been relatively subdued, so there hasn't been a huge amount to say on the lower time frames. But I still wanted to bring you a weekly video, and I wanted to use this week as an opportunity to just revisit my overarching sort of macro thesis for where we are in the market cycle and how that relates to where I see the price of Bitcoin, Ethereum, Solana, and cryptocurrency in general heading over the next probably 2 years, I would say, is the time frame that I'm looking at. So I'm going to dig into that. I'm going to kick off this week with the chart that you see in front of you, and this is Netflix. Before I do that, standard stuff, just to remind you that nothing you see or hear in my videos or that you might see over on my X feed on @part-time charts is financial advice. I do not want to think of anybody making financial or investment decisions off the back of any of my content. This is meant purely as entertainment, and I hope some of you find it entertaining. I hope some of you find it useful, and if you do, please hit the subscribe button and help me grow the channel. I would really appreciate your support. Right, so just digging into Netflix, I've been posting this chart for quite a while. Now, what's really interesting, if you go back and look at some of the charts that I was posting in 22, 23, granted, I was not the seasoned, skilled technician that I am now, but even back then I was pointing out that I expected a huge rally off the lows, and I joked about the meta chart looking really similar at the time, and the fact that Kramer had been crying on international TV on CNBC when meta was bottoming. In my view, it was a bottom, and he was, apologizing to all of his viewers for having recommended meta as an investment just before the sort of precipitous decline that we saw in 22. So right back here, I was saying that I thought there was a decent chance we had reached a bottom, and that we would come back up on stocks like Netflix and Meta to test this long-term trend line that has been capping price for a while. And lo and behold, we finally got there on Netflix. Now, it's interesting, I will admit that I did call a top on Netflix back here. And I remember at the time I saw Meta hit the trend line, the upper boundary, really cleanly. And I remember thinking, Netflix doesn't look as clean, really, we should be coming up into this 1150, 1160 region. But we didn't quite get there, and I thought, maybe that's good enough for a top. Since then, we've bounced hard, and Netflix has hit all-time highs and has put in new highs, while some of the other stocks, like Meta, are languishing some way, a good sort of 10-15% off of their, more like 15-20% off of the high that was put in earlier this year. So Netflix has been a late bloomer. It surged while most other equities and certainly the indexes have struggled to put in new highs recently. This one has been able to do so, and it's meant that we're getting a much cleaner look at that upper boundary that has capped price, like I say, dating all the way back to 2018. So unsurprisingly, I'm calling for a top here. I think in this region, this red circle is my target. I think we've got a tiny bit of upside over the next week or two, and then I expect to see a really big rollover in price coming all the way back into the sort of circa $100 mark. And what I wanted to do is dig into why I think that is going to happen, because lots of people, when I post these charts, lots of people are quite critical, and they'll say to me, well, look, this pattern has to give way at some point, right? Do you really expect it to continue bouncing between these trend lines forevermore? And the answer is no, but I think there are specific reasons that lead me to believe that we will see one more massive downturn, probably in the region of about 90% on stocks like Netflix and Meta, before we see a much more sustained move to the upside that will probably last several decades. So that's my take on it, and I wanted to talk you through why I've reached that conclusion. If you go back to the first video that I posted when I set up the YouTube channel back in March, I covered my macro thesis in quite a lot of detail, and in short, the macro thesis was massive correction in equities and crypto, big risk off period, inflation comes back, we see stocks crashing, historic downturn on a par with what we've seen in the 2008 crisis at least. And during that time, commodities do really, really well as people, flock to safe havens like gold and silver to fight off the inflation that we're experiencing in the economy, but also, broader commodities like oil, platinum, and other metals get dragged up by the impact that inflation is having on devaluing fiat currency. So that's the thesis for the next couple of years, and certainly what I'm seeing on Netflix at the moment really chimes with that. If I'm right and we do start to roll over and we come back into this space, I think a lot of people are going to be caught off guard and they're going to be shocked by the size of the decline. But look, let's tackle some of the criticisms of that perspective, because I think if you were to see this chart in isolation, you're absolutely right. You can't expect price to bounce between these two trend lines forever. So at some stage that's got to break, and I suspect what most people are anticipating is a bit of a pullback followed by a break to the upside and a continuation of the bull market. Now, why don't I think that's going to happen? Well, look, let's really quickly, I'm seeing this pattern, this sort of like megaphone broadening pattern play out on a few different assets. And Meta, as I've already said, I was convinced that this rising wedge and the throw over, the break back beneath, was going to mark the market top. And since then, despite the fact that Netflix has been able to push off these lows and back up to new highs, Meta has been able to do nothing of the sort and is still down 15-20% off the all-time high that we put in earlier this year. And blue squiggle here is my forecast. Again, people think I'm crazy, but I'm expecting a 90% decline for Meta. And I think fundamentally, this is going to be symptomatic of what I see as the popping of the everything bubble. For 40 years, central banks have been able to print money, have been able to lower rates consistently, and to accelerate that trend in response to every crisis that comes. But in recent years, inflation has been making that difficult. And so my thesis is that this is no ordinary downturn. This is no ordinary recession that we're staring at. But this is, in fact, a historic pop of a huge asset bubble that has been driven by money printing, by cheap money, by lowering of interest rates, and that trend has come to an end. And governments and central banks are stuck between a rock and a hard place, and now is the time to pay the Pied Piper. So I do not see any bullish case for risk on assets over the coming year, possibly two. And in fact, I expect these broadening patterns to play out perfectly and to shock everyone. And it's interesting because obviously I'm seeing this pattern on Netflix, and you can go all the way back to 2022 when I was first calling this. I said we would come up. I expected it to play out more quickly, but that we would come up to the upper boundary and back down to the lower boundary, and that the thing that would drive us on the way up was the stalling of inflation, and the ability for rates to stabilize and come down slightly. And the thing that would kill us on the way down would be the return of inflation and rates going higher. And I think we are starting to see early signs that those things are coming into play, and we can come back to that a little bit later or in a future video. But look, I'm seeing the same pattern play out on multiple assets. And interestingly, the one that everybody has seen me talk about, if you follow me on X, you'll know that for a long time I've been saying that I expect the Bitcoin market to top up here. I did think that late 24, early 25 might have been a top, and that we were going to roll over. It looks like we're coming back up for one more high to take out the early bears before we roll over. And again, I'm seeing the same pattern as I've picked out on Meta and Netflix. And people think that's crazy. People think, well, there's absolutely no way price is going to be so volatile that it continues to bounce between these trend lines. But I want to go back to the 60s and 70s on the S&P, because we saw really similar price action here look, this is the index, right? And I think I wasn't around then. I wasn't alive in the late 60s, early 70s. But I imagine if we were talking about price action back then, we would have been, a lot of people, perhaps not me, because obviously, you know, I am the part-time trader. I would probably be able to snuff this out if I had access to TradingView back in the 60s or 70s, which might be unlikely. But a lot of people back here, I think, would have been really bullish. You know, stocks had faced two corrections of pretty sizable magnitude. So first in 66, we saw 22% decline on the S&P. And then from the peak in 68, after the market bounced back, we saw another decline of about 40%, which is more or less on a par with what we saw in 2022 on the indexes. And then as price bounced hard off of these lows and started to make new highs, I suspect lots of people here found it unimaginable that the market would trend so much lower over the coming months and actually come back to break the low that we put in here. But that is what happened. And what's really interesting is that if you look back at the driving factors, so my main thesis for the market is that we are entering a period of severe stagflation where the economy does not and cannot grow, but where rates head higher in response to inflation. And what's really interesting is if you go back particularly to the early 70s, it was that exact same set of conditions, a stagflationary economy, that led to this massive turning point here. And if you look back, commodities, gold, oil, all did really well during this period. And for about a decade, for the best part of a decade, from about 72, 73 up until about 1980, oil and gold absolutely dominated equities in the S&P 500. And that's exactly what I'm expecting to play out now. And so anybody that tells me that a third dip on these assets to complete this broadening wedge pattern, to complete this megaphone, is impossible, well, I beg to differ. I think the conditions are exactly the same as they were in the 1970s. In fact, they're probably worse from a fundamental point of view, because if you look at how levered governments are, if you look at how levered the average consumer is, how much leverage is in the financial system, I really do expect that this kind of move to the downside, which took a good nearly close to 2 years to play out, I really don't think it's ridiculous to expect something similar in 25 and 26, possibly into the first half of 2027. So that's the first part of my argument, is that if you think it's ridiculous that these are going to roll over and complete that megaphone broadening pattern, then you only have to go back 4 or 5 decades to see that the market has done this before. And I don't think it's out of the realms of possibility that we see a similar move in the future. And the other part of my argument is this, and I covered this in early March in one of my first videos. I'm not going to dwell on it too long because that's still there if you want to go back and take a look. But look at this. This is the yield curve, right? So this is long-term rates on US government debt minus short-term rates on US government debt. And in a healthy market, you would expect to yield a bigger return on long-term debt than you would on short-term debt. But when the market becomes unhealthy, we see the opposite. And you look at these periods of time, and I've covered this in a bit more detail in the first video on the channel, so go and check that out if you haven't had a chance to watch it yet. But if you look back at these periods where we've seen what is called yield curve inversion, you see that they all coincide with major corrections. And this pattern goes way back. I can't pull up the data on TradingView, unfortunately, beyond the late 80s, early 90s. But this pattern goes all the way back to the 1950s and possibly earlier, that every time you see significant periods of yield curve inversion, what follows is a deep economic crisis and a massive contraction in the values of risk on assets. So why the hell do we think this period is any different? I mean, this is the deepest and longest lasting yield curve inversion in history. I think, there's loads of people out there that seem to have forgotten about this. A couple of years ago, this was a really popular indicator, and lots of people were trying to call the top on the market. But what's happened is stocks have continued to push higher as the yield curve was inverted, and indeed, as it's been uninverted since the back end of last year, stocks have held steady, crypto's held steady, Bitcoin looks like it's heading to new highs. And I think what's happened is people have just forgotten. They've been lulled into a false sense of security. If you were early on calling this as a major warning sign, obviously the market's made you look a bit silly over the last couple of years. And so lots of people are scared to touch on this now and or have just forgotten about it. But I think the fact that stocks kept pressing higher as we were inverted, the fact that this inversion lasted for the best part of 2 years and went way deeper than anything we've seen in recent decades, I think that's a major warning sign. And if you're betting that this time is different, well, good luck to you. But I look back, and whether it's the bond crisis in 1990, whether it's the dot-com bubble popping in 2000, or the top of the market ahead of the great financial crisis, timing might not be perfect, but the yield curve inversion is an incredible predictor of a coming crisis. And interestingly, we are now at more or less the level that the yield curve had disinverted to before we saw a major market top in October of 2007, when equity started to roll over into what we now know as the great financial crisis. So look, a combination of historic analysis and seeing that this kind of pattern has played out before, that we're facing similar stagflationary conditions, that this pattern, this megaphone pattern, is present on multiple assets, and it coincides with the disinversion of the yield curve. I just think the stars are aligned for a massive crisis, and I think we are only just at the very beginning of what will, in the rearview mirror, look enormous and will cause a lot of pain for investors, for everyday Joe Blogs who are either dependent on the stock market for a pension or struggle because the wider economy is in the toilet. I think it's going to be a painful ride. Back in 2022, we saw the impact that inflation can have on people's ability to cover everyday living costs. If inflation comes back at a time when economic conditions have worsened, I think 2022 will look like a bit of a walk in the park compared to what we're about to experience. So from my perspective, I'm looking at the combination of these factors, and I'm looking at what the bond market is telling me about where markets are heading. And I refuse to believe that this is merely a bit of consolidation before equities make new highs and before crypto heads to the moon and Bitcoin blasts off into the 7-figure region that Saylor and others have been promising us for many years now. I think quite the opposite. I think people are going to be caught out. The level of exposure among retail investors in the market is at historic highs, and there's lots of data points on that. Some of them I retweet from other people. But people are really, really exposed to this market at what I think is a point of maximum risk. And when I look at this pattern, so this is TLT, so this is a 20-year Treasury bond ETF. And I use this often as a bit of a proxy to gauge the health of the bond market. I posted this a few weeks ago. This, to me, the breakdown of this uptrend that dates all the way back to the early 2000s and coincides with rates coming down all the way back since the 1980s. The top of the bond market at the peak of the COVID crisis in March 2020 has left bonds really struggling. And now they look to me like they're on life support. And I describe this line here as the gates of hell, because I think what happens globally in markets when this line is breached is not going to be pretty. Like I say, I think a lot of people are going to suffer. And I don't say that lightly, because look, as much as we like to take a look at crypto prices and speculate on where Bitcoin is going to end up, these things, these macroeconomic factors, they have real life consequences for people. People will lose their jobs. People will struggle to pay the bills. The value of people's investments will go down significantly. I think people are in for a really, really rough ride. And you add to that the backdrop of global uncertainty, the tariffs that Trump is putting into place. Interestingly, go and do some research on what happened in 1929 when the US started hiking tariffs on countries that were exporting to the US. That coincided with the Great Financial Depression of 1929 and 1930. I just think there is an awful cocktail of the death of the bond market, the return of inflation, central banks and investors calling time on government profligacy, ridiculous levels of spending above your means for many, many decades. All of that is coming to an end, in my view, and the markets will not digest that easily. They are going to head much, much lower. And certainly what I'm seeing here, this life support line, the bounces are getting weaker and weaker. I think we're going to come back, and eventually TLT and bonds are going to go much, much lower. And as a result, rates are going to go a fair bit higher too. So lots to be pessimistic about, in my view. And nothing is shifted on the higher time frame. I've been bullish on Bitcoin the last few weeks, and I've made some good money long in Bitcoin. But I refuse to entertain at this stage the notion that Bitcoin is somehow about to blast off into the stratosphere, and we're on the brink of a historic alt season, and all is going to be well, and everybody's going to make loads of money and dance off into the sunset. It's just not going to happen, in my view. Let's take a look at lower time frames on Bitcoin then. So, overarching thesis is markets are putting in a top. I think I'm expecting a huge amount of volatility, and the yield curve disinversion and the state of the bond market point to that being the case. But in the short term, I'm still bullish on Bitcoin. You'll remember that a couple of weeks ago, mid-April, I went long as we broke this downtrend, and I called for these two targets here. The first being this 100k level, where we take out what I suspect is a fair chunk of liquidity at these highs, and the second target was back up at a retest of this major trend line that has been capping price back to 2021. And nothing's really changed in my view. I have a feeling that we will take out the 100k mark pretty soon, probably over the next 3 to 5 days. And I also believe now that this orange scenario where we top out there and we come back down is unlikely. I genuinely think Bitcoin is going to go a fair bit higher over the next, 2 to 4 weeks, and take out these highs, throw off all of the early bears before rolling over and beginning the major correction that I've been calling for some months now. So nothing has really changed on the lower time frames. I'm expecting more upside. I still see, like, if you look at some of the tools that you can use to look at funding rates on futures in the crypto market, it looks to me as though shorts are continuing to pile in here, and I think all of those will get blown out. We'll take out all the liquidity that's built up in this range over the last 4 to 5 months, and eventually we'll end up topping out here before beginning the correction. And what's interesting, I posted this earlier in the week, but if you look at the Netflix chart alongside BTC, back here, right, this is Bitcoin, the red line. back in 21, we put this high in the spring, saw a really big sell-off, big decline, and then price managed to work its way back up to highs, and the space between this high here in April and this high here in November was about 7 months, so 6 to 7 months in total, that saw us come down, go back up, take out the highs before rolling over into a much deeper correction. And it's interesting that Netflix topped exactly at the same time as Bitcoin, and here I'm calling a top on Netflix as we come back into this downtrend, and I'm anticipating that BTC does something like this over the coming months, takes out this high, grabs a bunch of liquidity in the 110, 115k region, and that in hindsight it will look quite similar to this, that we've had a top, we've had about 6 months of decline back into a new high before rolling over. So there are similarities, I think, between the price action that we're seeing now and what we saw at the 21, early 22 top in the market. So that's Bitcoin on the lower time frames. Still anticipating more upside before eventually we roll over. My TP on the current long that I've got out there is 110k. We could go slightly higher than that. We could even wick up into the 120 region. But when we do get up there, I will be thinking about positioning myself accordingly for the correction that I see coming. And then a couple of other lower time frame charts. So Solana, another perfect call, if I may say so. You'll remember that back here I was saying that a break back into this region here and a reclaim of all of these lows would be bullish. And when we were here, I said, look, the first green trigger has been pulled. I set 2 targets here and here. We've reached the first quite easily, and the second trigger, and I've not touched this chart for well over a month, but the second trigger has also been pulled, because as you can see, the plan was that if we reclaim this level here, that would be key support for us to press higher. And on the daily time frame, we had a pretty deep wick a few days ago, back on Wednesday, before reclaiming this level. And I think anything above here, I'm interested in longing with the next TP at $180. Now, I have said it's possible that Solana pushes a bit higher, so I could see something like this. I could see something coming back into this downtrend before rolling over. I do think on balance this will probably be a lower high, but even if we were to come all the way back up here and take out the all-time highs, for me that still wouldn't be a sign for me to get back into the market and to be bullish. And if you look at the Solana BTC pair, I think the upside is going to be capped. So I can't see us going back into the $300 range. I think we've got maybe another 20 to 30% left in the tank. So that's Solana. And then on Ethereum, this is the short that I am desperate for. I think if we can take profits on Bitcoin longs in that 110k region, I'm anticipating that Ethereum will come back into this region before rolling over alongside Bitcoin. And what I'd love to see is that these highs here get taken out. I would absolutely, between 2,150 and 2,200, I would be looking at going short, and that would be a big swing move for me. So I think first target would be to take out this wick here, but I expect that the downtrend would continue and that eventually we'd come back to take out this level. It's an awful pattern, isn't it? We'd come back to take out this level here, and I would be taking profit in about the $950, $1,000 region. That's a big move. You're talking about 50% downside. Obviously, if we were to start reclaiming this on the weekly, then I'd have to rethink, and potentially that would be a trigger for some longs. But the fact that this has held a support and resistance so many times over the last few years think that just tells me that any move back into this region is likely to be a bearish underside retest, and I'd be thinking about going short, particularly if that coincided with BTC hitting those levels that I've talked about. So that's probably about it for this week. I did just want to end, I've talked a lot about where I see markets heading, the fact that I think commodities are the place to hide over the next couple of years as all this drama unfolds, and are potentially the best way of multiplying my capital as I think about, growing my pool of capital to invest when Bitcoin eventually does bottom and when stocks bottom in what I think is going to be 2027. And one chart that I wanted to pull up is this, which is the oil versus S&P 500 chart. I love this chart because if I'm right, and we are in a sort of like 1972, 73-esque moment where equities begin to top out, and we see some big moves in commodities. I just love the correlation here. So if you look, the bottom, so oil versus S&P broke this downtrend in the late 60s, came back to retest this level, and then just as the S&P topped in 72, oil began to absolutely boom. And for 7 years, for 7/8 years, oil absolutely dominated the equity markets. And I think there's reason to believe that we're on the brink of a similar move. So while everybody is cautious on oil, and yes, it has broken a key level, and you can see some of the USD charts that I've posted recently that point to that, I think the way that price action is unfolding on this chart leaves me reason to believe that oil is going to catch up with gold. Oil historically has a really tight correlation with gold in a higher time frame. While gold has outperformed massively in recent months, I think oil is the catch-up play. And once again, we're seeing support at the lower boundary of this falling wedge on oil versus the S&P. And bigger picture, I think this is some sort of broadening descending wedge with a massive wick to the downside during the COVID crisis when oil prices collapsed and went negative. When this breaks up, I think that will be the start of a multi-year bull run in the price of oil, and that oil stocks, particularly those that are trading at really attractive PE ratios at the moment, and there are lots of them on my feed on X at Part-Time Charts, I think those stocks are going to do extremely well. So my game plan is that I plan to capitalize on what we're seeing in gold and silver, where miners are massively undervalued relative to the underlying fundamentals and prices of those commodities, particularly in the gold space right now. And I also plan to capitalize on the catch-up trade in oil when it finally begins to boom in the way that we saw back in the 70s. So again, more reason to believe that my thesis around stagflation, the return of inflation, just as equity markets turn sour, that there is some validity to that belief, and that we're likely to see some of that play out. So looking for a break in this falling wedge, and then this bigger descending broadening wedge pattern with a couple of targets outlined here. And this move is massive. So even if we only went to the first target, we're talking about a 10x move in the price of oil versus the S&P. Granted, I'm expecting the S&P to go down during that time, but this could be absolutely enormous. And we saw something similar back in the early 70s. So just to recap, massively bearish on equities. I think people are unbelievably complacent about where we are. The yield curve is pointing to a major crisis, as is the bond market. It's the end of an era. It's the end of 40 years of declining rates, of overspending, of leverage in the system, and it's all going to come down with a big bang. And oil and gold and silver are where I'm looking for a safe haven at the moment. and I'm hoping that my capital will appreciate in those markets before we buy a massive generational bottom on crypto in 2027. So that's how I'm thinking about the market. Like I say, none of this is financial advice, but hopefully you find some of the ideas and my way of thinking helpful, or at least entertaining. If you find any of this useful, then please do hit the subscribe button. Would love to have you with me on a more regular basis. Hope you have a fantastic weekend, and I will catch you all again soon.